J.C. Parets. He's the founder of Eagle Bay Capital. He's a 10-year veteran of the markets and a market technician, active manager. Let's talk to J.C., get his take on the Fed.
Hi, this is JC.
J.C., it's Joel, Dennis, and Brianna. How you doing this morning?
I'm doing well. How are you guys?
We're doing good. We're sorting through some of the earnings, and we're just trying to figure out this Fed. I know you just like to trade your style and not pay attention, but I have a question here from a buddy of mine, Helmut, and he wants to know, how can the Fed claim to be data dependent and yet respond and yet reassure the market that the timing of the first hike is more important than the fact that they will gradually raise rates? In other words, data dependent yet promising to follow a gradual path of raising rates.
I mean, I think you're proving my point as to why I don't listen to any of that stuff. I mean, what does that even mean? I truthfully, guys, from the bottom of my heart, I honestly have no idea what any of that means or why any of that is even relevant.
Yeah.
I mean, quite frankly, who cares what the Fed thinks? I mean, seriously, who cares what the Fed thinks or says or what economists, it's the most irrelevant conversation that people have been having for years. And just think about the amount of time that has been wasted over the last several years having these sorts of discussions that I still don't know what you're talking about. I find it completely useless, which is why we study the markets, we look at price, and we ignore what the Fed thinks. The Fed doesn't control interest rates. The market does. So who cares what the Fed thinks?
Could it
JC, to your point, I just want to bring this up actually, and this is interesting here. I was reading an article last night. It was dated from 2010, and in the article they were interviewing economists, and most of the economists thought in 2010 they wouldn't raise rates. Some of them thought in 2011, but they said definitely by 2012 we're going to be raising rates. We were talking about this raising rates here back in 2010. Here we are in 2015. We still haven't raised interest rates here. So you're right. This is just, it seems like everybody what they talk about, but is this even market moving here anymore? Because it really seems irrelevant here. I mean, the Fed just
listen. It's good. It's good for unemployment. It keeps journalists employed because it gives them something to talk about, every 8 weeks, and it keeps economists employed. I still to this day I agree with Warren Buffett. I don't know what value they bring to the table, but at least it gives people jobs.
Okay, let's move on here then, JC. Move away from the interest rate talk for a bit. What is on your radar here for today? We did see a nice rally back here again in the S&P future. Seems like we're still in this trading range. Every time we get down to the lower 2060s, we seem to find buyers. We get in the 2100s. We seem to find sellers. What's on your radar and how are you approaching today?
Yesterday, as far as the S&P 500 is still in a trading range, as you guys know, I think that's we've been in a trading range that hasn't changed. To be getting chopped up in that chop fest. I obviously want no part of it. But what I found interesting, I'll tell you a little story. So yesterday morning, the market was doing well. Bonds were getting slammed. Interest rates were up all morning, and regional banks gapped up on the open. So everything making sense. Everything. Both hunky and dory. And then all of a sudden, regional banks start fading. Market, throughout the morning. Stocks are still at highs. Interest rates are still at highs. But regional banks are getting slammed. And I really thought that was interesting. And I really thought that was a big tell in terms of, from a global macro perspective, what was really going on underneath the surface. And, while everyone's arguing about, what words Janet Yellen is going to take out of her speech or whatever nonsense they were making up yesterday, I thought that was very interesting. And that was really the tell in terms of rates. As you know, rates went out at the lows of the day, bonds ripped in the afternoon, and regional banks went out at lows. But I thought that while the market was at highs and rates were at highs and regional banks were getting slammed, and not really getting slammed, but fading from their highs, I thought that was the tell. So we went ahead and we shorted regional banks yesterday morning early. And I think that's an interesting trade right now. Markets are up this morning a little bit, but I like it. And if we can take out if we could take out the lows from Tuesday in KRE, I think that would be the confirmation that we're going to get a nice little correction in regionals, perhaps down under 42, which is a big move, for an overall average. Essentially kind of just go down and retest the breakout level from last month. But I think that can make an interesting trade, and because we caught it early, we got a nice little entry point. Regional banks hit our initial target already. So I've kind of, I haven't really been too optimistic about it. And the fact that we got that fade yesterday morning, I thought that was a good entry point. And I would be adding to positions if we take out Tuesday's lows to the downside. And then from a risk management standpoint, where we originally started shorting it, in the high 40s, we start getting back above 45, all bets are off. So from a risk reward standpoint, it's very much skewed in our favor, which we're happy about, obviously.
44.09 was the low in yesterday's session. The level JC's talking about is 43.96. That was Tuesday's low. JC, back a little bit to the Fed speak. Maybe they're rallying gold because exactly what you just said. The Fed does not know what they're doing. They don't know what to do with rates. The economy's not that hot. Are you chasing gold here, flirting with the $1,200 level? We did get to 1203.70, or hands off on gold?
Well, let me be clear. I never said that the Fed doesn't know what they're doing. I'm sure that they know exactly what they're doing. I'm sure they're very intelligent people. I don't know any of them personally. I don't know whether they know what they're doing or not. It's not my job. It's not any of our jobs as market participants to criticize the Fed. I see a lot of people out there constantly criticizing what the Federal Reserve is doing. That's not our problem. That's not our job. I have no idea what the Fed is doing or why they're even there. That's not our job. Our job is to profit from what they're doing, or for that matter, what they're not doing. So I just want to make that clear. In terms of gold, I don't know what the Federal Reserve and gold have anything to do with each other. Gold is still in a secular decline. This is a terrible, terrible bear market. And buying gold, not at all. We're running into a downward sloping 200-day moving average. There's been no reason to be in this trade. Anybody who's been in has been losing money. You want to know what's an interesting one that I'm looking at?
Sure.
I think is a tell for all the precious metals is platinum. Platinum, people talk about silver, how it's the more volatile, ugly stepchild of gold. I think platinum is even crazier. And it's the worst of the three. So I think the fact that platinum broke below the March lows and is now really kind of flirting with getting back above that, I think is very interesting. If you see a squeeze in platinum back up towards 1180, you're probably not going to get too much weakness in gold. But if platinum rolls over, you're probably going to get those new lows in gold and silver, which by the way, I'm not in these trades, but I ultimately do think they're coming. I think all precious metals head lower. I think gold goes down to 1,000, silver down under 14. I think they're all going lower. Whether they come from here, whether they make new lows, whether they get to higher levels before rolling over, is still to be seen. But these are terrible bear markets. I mean, horrible. So to be, bottom fishing on something like this, which, I don't have a problem doing, you really want to do it in a scenario where you have upside. And I think if you're buying gold into a downward sloping 200-day moving average within a multi-year secular decline, from a risk-reward standpoint, that doesn't make too much sense to me.
Okay, let's move on to something that is moving up here instead of trying to buy something moving down. Something that's been moving up is Tesla. And Tesla broke out again there yesterday. Had a nice pop. At one time was up over $10 on the day. Did close off the highs just slightly here, but is catching a little bit of a bid in the pre-market here this morning. TSLA has been hot really for the last 2 months. It went from 200 to 260. Does the run in Tesla continue?
I don't trust it. I don't like these flat 200-day moving averages. I really don't. And we have one here. So whenever I see that, these sorts of rallies tend to fail. So me personally, that alone will keep me away. So I simply just will not buy a stock that quote unquote is breaking out with a flat 200-day. I mean, that just has failed breakout and mean reversion written all over it. And if it keeps going and I miss out on 20, 30 points of Tesla, so be it. But, you got to stick with your process, right?
I got another one for you then too. Amazon here. It's been consolidating here for a long time, had the gap and go off the earnings, and it's just been digesting that earnings report here for the last month and a half, basically trading in a range between 420 and 440. Where's Amazon going?
Yeah, I like it. Amazon looks great, man. Amazon's probably had 485. It's the 161.8% Fibonacci extension from 2013 to 2014 decline. So, and I love the way it's been flagging here. I think you nailed it. I mean, the daily chart is interesting, but look at the weekly chart. I think that really tells a story. You know, you had a breakout above the, the early 2014 highs, and it's been consolidating this little pennant, right? So I think when you see these sorts of patterns, they're very, they tend to resolve themselves in the direction of the underlying trend more often than not. So, in something like this, I would argue that it probably breaks out, and I would be a buyer of that breakout and be selling it at 45. Totally, good one.
Out of the chat here, interesting chart. Alibaba, BABA, stock has been pretty volatile since earnings. Now coming back. Are we get a chance to buy this back, fill the gap here down at the 80-50 level? Or if you want to get in, you got to stick your toe in today.
Yeah, I don't know. It's an ugly one. You know, they don't get much uglier than this.
Nice head and shoulders there for you too. I don't know. Do you use patterns ever? Do you ever look at patterns there, JC? Like a head and shoulders?
Yes, I am a big pattern recognition guy. We're just talking about a pennant in Amazon. Head and shoulders in this. Man, I don't know. I don't know about that. I don't know what
you don't see it kind of it. Am I reaching there to say that little left shoulder? It's a kind of an ugly head, but maybe deformed a little bit. But I'm looking at the left shoulder in May, and then at the end of May we made the spike up to 95, where we kind of almost put in a double top. Now we're kind of trying to form the right shoulder there. Do you kind of see it?
So I had a continuation pattern, really.
Or am I reaching for that one?
I see what you're saying. You're seeing a head and shoulders continuation pattern, not a reversal.
Yeah.
Right.
Yeah. I guess maybe. I mean, probably because this thing's such a disaster, right? Whether it's the head and shoulders or not, I don't know. But yeah, it's bad.
Yeah.
I don't know.
It just
if you have to be in it, I would not be in it below Wednesday's lows. That level of support was consistent. In March and April. Yeah, I mean, it's messy, man. It's messy. I think, there's nothing clean about it. Who knows where this thing is going. I just think there's easier trades out there. I mean, why Alibaba? Because it was the biggest IPO ever or whatever. There's thousands and thousands of stocks out there. And, if this is the one that you choose out of those 6,000, I mean, I think if you put in the work, you could, I bet you could probably find something a little better.
It's interesting too that the low on earnings day was $84.91, and you had that spike up to the $95 level, and now it's coming back down here. For me, if I was trying here at the 86.80, I think I'd give it a little bit more room here, down to that low from the gap at 84.91. JC, we're getting out of the chat here. We asked you about some stocks that you're looking at today. Is there any other ones you want to bring our attention to? I see that you did some tweets here on Apple. Is that on your radar for today?
Yeah, I mean, Apple's definitely on my radar for the simple fact that, as you guys know, coming in, in early February, when, or late January for that matter, we're looking for a breakout above the fourth quarter highs. And we said, if we broke out above those highs, we'll see 129 pretty quickly. And that's exactly what we got. And as you know, we've gone absolutely nowhere since hitting that 129 target. And, it goes back to, our old buddy Leonardo Fibonacci. And if you're not looking at these Fibonacci levels, I think you're really doing yourself a disservice, because it's been absolute dead money since late January, had you ignored those levels. So what I see here is, if you look short term, you got a bullish continuation pattern theoretically, right? Call it a bull flag or a pennant or whatever it is, but you have a sideways consolidation after hitting our target in February, where it's essentially gone nowhere. And these sorts of consolidations tend to resolve themselves in the direction of the underlying trend. However, not only have we already hit that price target on multiple time frames, but and I tweeted out that chart, and I bet that's probably what you're looking at. You've got long-term, you got a long-term trend channel that we're bumping into the upper end. So, from an entry point perspective, to be buying Apple here, to me, bigger picture, longer term, makes very little sense. So when you boil it down, and that's why I think using a top-down approach is so important. Working from a larger time frame and working your way down. So from a longer-term time frame, I think Apple's a terrible buy here. But then when you look shorter term, it looks like it's a bullish continuation pattern. The problem is when bullish continuation patterns resolve themselves negatively to the downside, as opposed to breaking out like a bullish continuation pattern should, there are larger forces at work, and the market is speaking. The market is telling us something. So I would look potentially for a breakdown here in Apple, and I think that would bring very negative implications. So because bigger picture, it says be careful, and then short term, we hit our target already, and this quote-unquote bullish continuation pattern is taking so long to resolve. I would argue if it was going to resolve to the upside, it would have already done so, and it hasn't. So if this thing breaks down, which I think that there's a pretty high likelihood it can, that would be very, very bad.
Yeah, it doesn't look like this watch is going to be a big blockbuster either. I hear a lot of chat. Kramer was talking about the batteries on it, and I've read a couple articles. But we've been on the line with J.C. Parets. He's the founder of Eagle Bay Capital. He's a 10-year veteran of the markets. He joins us every Thursday morning at 8:35 to give us his colorful commentary on the market. J.C., great as always to speak with you. We'll talk to you again next week.
Thanks for having me, guys. Have a good one. Go get them.
Thanks, JC.